Listen up, because what's happening in the silver market right now is unprecedented, and the mainstream financial media is completely missing it. While they're asleep at the wheel, a massive repricing event is brewing, and the warning signs are flashing bright red. Tomorrow marks the beginning of what some are calling Ghost Week in the markets, a period that could kickstart an explosive move in silver, potentially adding $8 or more as we head into the new year. Let's start with the most glaring signal, the massive price dislocation between the East and the West. Right now, a silver contract on the COMEX in New York trades for around $74. But if you look at the Shanghai Futures Exchange, physical silver is trading near $78.50. That's over $4 difference per ounce. This isn't your normal everyday arbitrage opportunity that gets closed out in minutes. This gap is huge, it's persistent, and it's been growing for weeks. What does this tell us? It signals a serious breakdown in the global pricing mechanism. The paper market is losing control. You see, Western markets like the COMEX in London trade mostly paper contracts, derivatives that represent silver. But in the East, particularly in Shanghai, they trade real, physical, deliverable metal. The center of gravity for price discovery is shifting from west to east, from paper promises to physical reality. And the force driving this shift isn't just speculation, it's ferocious industrial demand. We're talking about the real-world need for silver in solar panels, electric vehicles, 5G infrastructure, and all kinds of advanced electronics. These aren't financial speculators playing games. These are factories in China and across Asia that need physical silver to build the technologies of the future. This isn't a demand you can regulate away or talk down. It's structural and it's inelastic. This insane demand is causing inventories to collapse at an alarming rate. In just the last 2 weeks, silver inventories on the Shanghai Gold Exchange have plunged by 18%. Over at the Shanghai Futures Exchange, stocks are down a staggering 44%. We are now at 10-year lows for physical silver in China. The warehouses are being emptied. And it's not just a problem in the East. The COMEX in New York is facing its own inventory crisis. While they claim to have a certain amount of silver in their vaults, over 60% of the registered category, the silver actually available for delivery, has already been claimed. The COMEX operates on a fractional reserve system, much like a bank. They don't have enough physical metal to cover all the paper claims if everyone decided to take delivery at once. With inventories this tight, the risk of delivery stress, or even the exchange changing its rules to prevent a default, is becoming a very real possibility as we look towards 2026. This situation has created a powerful arbitrage trade that's draining the West of its physical metal. Shrewd traders are buying paper silver contracts on the COMEX for cheap, demanding physical delivery of the metal, and then shipping it straight to Shanghai to sell for a higher price. After shipping and insurance, they're netting around $3 per ounce every single time this trade happens. It drains more physical silver from Western vaults and further strengthens the pricing power of the East. This creates a dangerous self-reinforcing feedback loop. As more silver flows from west to east, inventories in London and New York get even tighter. Tighter Western inventories make the Shanghai premium even larger. A larger premium incentivizes even more arbitrage, which accelerates the inventory depletion. It's a death spiral for the paper price suppression we've seen for decades. Now, I know what some of you are thinking. We've seen silver spikes before, like in 1980 with the Hunt brothers, or the big run-up in 2011. But this time is fundamentally different. Those past rallies were driven primarily by investment speculation and massive amounts of leverage. They were financial events. Today's rally is being driven by industrial necessity. Factories need silver. This is a physical event. And the situation is about to get even more critical. On January 1st, 2026, new export controls from China are set to take effect. Silver exports will now require government licenses. This could remove up to 2,000 tons of silver per year from the global market. China is no longer treating silver as just a precious metal. They are treating it as a strategic material, vital for their technological and economic ambitions. Let's look at the global picture. The world produces about 25,000 tons of silver each year. Industrial demand already consumes more than half of that. When you factor in China's export restrictions on top of surging demand from the green energy transition, you create an unavoidable structural supply shortage. There is only one mechanism to balance a market with constrained supply and inelastic demand. The price must rise. It has to rise high enough to ration the available metal. Some analysts are already projecting prices of $120 to $150 per ounce, or even higher under these supply shortage scenarios. And here's the kicker: investment demand is still incredibly low. Silver ETFs currently hold around 600 million ounces. That sounds like a lot, but it's only about 2 years' worth of industrial demand. What happens when the big institutional money, the pension funds, the hedge funds, the sovereign wealth funds, finally wakes up to this reality? Even a tiny allocation shift from these giants could completely overwhelm the already strained supply, triggering a historic repricing. We're witnessing the transformation of silver from a simple precious metal into a critical industrial commodity, right alongside copper, lithium, and cobalt. This could be one of the largest and fastest commodity repricing events in modern history. So, how do you position yourself? You can buy physical silver coins and bars for direct exposure to the supply squeeze. You could use ETFs for liquidity, though you do have to consider counterparty risk. Or you can invest in mining stocks, which offer leveraged upside, but also come with operational risks. The key is that the timing is critical. The export controls are looming, inventories are vanishing, and the institutional money is still mostly on the sidelines. This isn't just about finance, it has major geopolitical implications. Silver is becoming a vital component in the race for energy transition and technological dominance. We're seeing a rise in resource nationalism and a frantic push to secure supply chains. The core thesis is simple. Silver is undergoing a permanent structural repricing. The huge premium in Shanghai isn't a fluke, it's the canary in the coal mine, an early warning signal of the earthquake to come. The window to position yourself before the rest of the market catches on is closing fast. This isn't a call based on speculation or chart patterns. This is about unshakable fundamentals. The question every investor needs to ask themselves is whether they will act now based on the clear evidence, or wait until this story is on the front page of every newspaper when the biggest gains have already been made. Silver is no longer just an investment, it's a strategic resource, and its day of reckoning is here. Thanks for watching. Don't forget to subscribe for more updates as this story unfolds.